Traders. Thank you for joining me in another Unicapital Securities Market Update webinar. I am Justin Tembrevilla, Research Head of Unicapital Securities. The title for today's webinar is Weathering Market Shocks, Strategy in the Midst of a Pandemic. So as you can see, we are still battling this health pandemic, which is COVID-19. And maybe a quick market update will keep you informed about the developments in the local equities scene. Similar with our previous webinars, the outline would be a glimpse on our country's macroeconomic numbers, as well as the US markets, and then the beef of our discussion would revolve around Philippine equities. So let's start. So for the first graph, you can see that Philippine GDP contracted to negative 0.2% during the first quarter, and economists are looking at a contraction of around 2% for the full year of 2020, with the impact could be felt by second quarter as the government imposed tighter lockdown measures during the said period. So as compared to the 0.2 contraction during the first quarter, the lockdown back then was just around 2 weeks, which started in mid-March. However, for the second quarter, during the second quarter, lockdown have been gradually eased starting around late May. So by June, we are now at GCQ in most areas, which resulted to some businesses reopening again and could give some positive outlook for the economy. Then for the next graph is inflation, wherein it settled at 2.1% in May. It continues to ease as the transportation index and the heavily weighted food and non-alcoholic beverage price increases remain low because, of course, most people are indoors, and as you can see, mass transport has yet to be, or the ban on mass transport such as public utility vehicles has yet to be lifted, so there's no reason for transport prices to increase. Then the BSP raised inflation outlook to 2.3% for 2020 from previous forecast of 2.2% during their monetary board meeting just yesterday. So next chart is the interest rate corridor and reserve requirement. So just yesterday, the Monetary Board of the Bangko Sentral ng Pilipinas conducted its fourth Monetary Board meeting, and it was a surprise that they decided to cut interest rates by 50 basis points. However, Governor Jokno reiterated that their move was to infuse liquidity to the system and to spur economic activity as we slowly rebound from this crisis. So currently, benchmark rates is at all-time low of 2.75%. This is the reverse repurchase, overnight reverse repurchase, or the yellow line, if you can see on the chart. However, the Monetary Board officials did not cut reserve requirements, coming from a 200 basis points cut last April. So currently it stays at around 12%. Well, from what we're seeing at this rate cut by the central bank, from an investor's standpoint, BSP is sending a message that if you have spare money, you have the option to spend it or invest it in high-yielding instruments like equities. Because if you decide to park your money elsewhere, let's say bank or savings account, returns will be very low due to the current interest rate environment. So for the next chart, we go to US markets. So year to date, Dow Jones and S&P 500 are down 9% and 4% respectively. We know that it was a stellar year in 2019 for the US markets, with the main indices rising close to 30% for the full year. However, even the world's largest economy wasn't spared during this health crisis, and even the USA recording the highest coronavirus cases of around 2.5 million. So markets have reacted negatively when WHO classified COVID-19 as a global pandemic. However, a rebound was seen when uh, when countries have started placing their um, containment measures by implementing lockdowns and mass testing, among other things. So if you can see in Wall Street, from a low of around 18,000 in for the Dow Jones, it has rebounded by 40% and is now at around 26,000 level. Same with S&P 500, a 40% rebound was seen from the dip of around 2,200, now sitting at 3,100 levels. So currently in the US, coronavirus cases surge again, this time in the states of Florida and Texas, which caused risk off sentiment for investors. And one thing that they're looking into for any positive news could be the development of a vaccine. So we go now to local equities. For PSEi, we steadied at 6,000 level. So as of June 23, we closed at 6298, and we have rebounded 18% from dismal first quarter for the local index. So similar to our peers over the US, our rebound from a dip of 4,623 back in around March 19, we are now up 36%. Then factors to consider why the index is going up again, because of again economies have started to reopen. So we might see businesses, as you go outside, malls are open. However, some stores remain closed because of the lack of mass transportation for employees to go through from destination A to B, among other things. Then one thing to consider would be the fresh rate cut from the central bank, which could spur liquidity into our local market. However, for the next slide, you can see that PSEi is still trailing its regional peers. We're at the bottom end of the pack. But if you can see the trend here, markets that have started to recover are also the countries that were successful in its battle against COVID-19. Countries such as South Korea, Taiwan, and China, who are recording minimal losses for the year. But of course, they all suffered steep losses during the peak of the pandemic in their respective countries. So we go now to the share price performance of PSEi stocks, where you can see outperformers such as Telephone and Globe from the telco sector, as well as Pure Gold in the consumer retail sector. However, laggards remain among the manufacturing companies such as GT Cap, who's the franchise master for Toyota Motors. As you can see, vehicle sales slumped during the quarantine period, so our revenues for GT Cap could be heavily affected if you look closely into the company's operations. And even San Miguel, despite their efforts for its employees and the whole country, share price have tanked because production line is still far from 100% for these companies, as we have yet to address this pandemic. So you might have seen this chart from our previous webinar as presented by King. Forward PE band from 2010 to 2020. So we labeled the lines there for the standard deviation. So if you look, the black solid line are on the fairly valued levels, while uh, the broken lines are, the top broken line is expand means that at that level it is, the market is expensive, while the bottom broken line means that the market is cheap. Then on the extremes, extreme top is a very expensive indicator, the dotted line. Then on the bottommost part means that the market is very cheap. So currently we're at a very cheap level of around 12 12.4 times forward PE, which gives us a forecast of around 5,800 to 6,000 as a base forecast for PSEi. However, a bear case could point us to around 5,300 level, while our bull case sits around 6,600. So currently, um, there could be another round of pullback for the market once companies report their second quarter results. Recall that tighter lockdown measures were in place for a longer period in second quarter as compared to the 2-week lockdown in place during the first quarter. So we expect companies to bleed out in this quarter, while recovery could take shape as early as third quarter for resilient ones, while for some companies it might take a while. So we can highlight those in our next few slides. So we go now to the P comparison for PSEi. So for this one, we use the trailing PE as in contrast of the 12.4 times that I've mentioned in the previous slide. So with this at 7.7 times, we're at the middle of the pack. So we're fairly valued, or quite attractive as compared to our peers or regional peers. But if you look closely, when we hit market, when PSEi hit around 4,600, PE back then was, or have dropped to 10 times level. So if you'll notice at 7.7 times, you might think of PSEi as quite expensive. So the reason here is the revised earnings forecast for companies, wherein consensus is pointing at around 10% decline in corporate earnings for full year 2020. However, some views are quite bearish, looking at around 20% revenue contraction for most companies. So since P is a ratio that measures the value of every peso you invest in a company's earnings, the decline would signify that a decline in earnings would signify a higher PE ratio. So that's why we came up at around 7.7 times. But if there could be quicker recovery by third quarter or fourth quarter, of course the ratio could improve to maybe around 14 to 15 times. So we go now to the daily average turnover for the PSEi. So despite the shortened trading hours implemented mid-March, our local market managed to find the middle ground for value turnover of around 6 billion pesos per day. And luckily in June, we saw some windfalls coming from um, FTSE rebalancing and Merrimart IPO, wherein the company raised around 1 billion pesos for store expansion plans. So another reason for the pickup in the volume is of course bargain hunting of investors, because they seem to think that market is already undervalued and it's time to pick up from the dips of the previous months. However, net foreign transactions continue to paint a grim picture, wherein we're still net outflow in June of around 4.2 billion pesos. Net foreign buying last week partially offset the exodus of foreign funds. However, we have yet to see the light of net foreign buying for a single month since June 2019. So we go now to our strategy on which sectors we think could be on on the road to recovery or could bleed out for the rest of the year. So we'll start with the sectors that we are very positive going forward. We start with telecommunications. For telco, positive factors that we're looking into is, of course, surge in mobile data as most individuals are staying at home or working from home, which consumes a lot of data, even if whatever means they're using their internet, be it Wi-Fi or data. It would benefit the top telco companies, and because of that, we think that um, the sector will remain resilient post lockdown. But on the downside, with the lockdown period still in place in most areas, the rollout of telco infrastructure such as fiber, cables, wires, and even satellites and um, towers could be postponed to a later period, which could hamper the expansion of or the increase in subscribers for the top telco providers. And of course, you've seen the resilience in the share price performance of Telephone and Globe. So we go now to consumer, another sector that we're positive. However, I would like to draw the line between retailers of consumer staples and restaurant operators because it was a different story for the um, two sectors. For consumer, um, or for the retailers of consumer staples, demand has been robust since the lockdown, especially when individuals started panic buying, rushing to the groceries for or to fill up their stock and prepare for a longer lockdown. However, for the restaurant operators, we've seen some closures in stores for more than a month, which really hurt the top line of these companies. So that's a two different story for the sector. For consumer staples, positive points are operations have started to normalize. So we can see production plants restarting again, going online. However, there could be some supply chain bottleneck as some areas are still under tight lockdown measures. So when I attended a conference call of one consumer company, they cited that employees could not go to work because of the absence of mass transportation. So if there weren't any measures made, this could still be a scenario for the next few quarters, or could be worse because demand is slowly coming back to normal, but the supply can't figure it out how to match the demand. Then on the restaurant operators, resumption of dine-in services at 50% capacity is better than no dine-in services at all. And of course, we've seen increased delivery and carry-out sales or take-out during the lockdown period. However, this uptick in delivery and carry-out sales will only partially offset dine-in revenues, as it is evident in the first quarter revenue losses in some companies like Jollibee Foods and lower revenues for Max's and Shakey's. So for the next sectors, for banks, we have a neutral view because of these factors. So the fresh rate cut from the monetary board will bring funding costs down, which is positive for banks. But there could be lower revenues from fees and commissions because of the lower traffic in branches conducting transactions. And if we were to recover by third quarter, of course, credit activity would likely follow suit. So catch-up plans could be in place by that period. And with in connection with the previous point, The lower rates would be very good for banks which have a good trading portfolio, particularly in fixed income. If they were to unwind this position, it could generate good trading gains, but not as high as last year's trading gains level. So the main for banks, the main negative point here is loan delinquencies could pile up after the grace period has been lifted by the BSP. So if you recall, when we were placed on a tighter lockdown, starting in March, the Bayanihan to act as one act, or Bayanihan to heal as one act, resulted to a grace period on loans because, of course, businesses aren't um, deriving revenues from their operations, so it could be very hard to service their loans. So the BSP decided to put a grace period or moratorium on loans. But since we are now in GCQ, um, this has been lifted, and there could be booking of loan losses starting June onwards. So NPLs could spike up during this period. Then we go now to property. We also have a neutral view on this sector, with positive points as lenient terms could attract prospective property buyers, be it residential or for commercial use. Also, the reopening of malls. However, for residential, most project launches scheduled this year have been pushed back to a later period or sometime in 2021 because, of course, construction have been stalled. Um, there could be a drop in demand from future projects because everyone is cash strapped. So that's it for residential. While for malls, we can see that malls have resumed operations, although on a shortened hours. Most of malls operate only 10 a.m. to 6 p.m. or 11 a.m. to 8 p.m. around those times. However, we have yet to see foot traffic in malls back to previous levels. So there's a slow recovery in footfalls, as well as the store closures impacted or could impact occupancy rates going forward. Then for the office occupancy to recover as some employees resume work. However, there could be a vacancy rate, higher vacancies with as a result of spike in unemployment. So this has been really a challenging year for property. Not to mention that their hotel and leisure arms could also be suffering because of um, shortened operations, and operations could even be halted once or as tighter lockdown is placed to some areas. So for the next sectors, power and oil, we are negative on power and oil because of huge oil inventory losses as a result of the drop in global crude prices. Also, the surge in residential demand during the ECQ period was not able to offset the foregone demand from the plants and manufacturing facilities that have been offline during those times. So demand from commercial and industrial will never be offset by an uptick in residential. But some positive points: increased power demand for commercial and industrial segments can be seen as businesses reopen. Then for oil, land travel could spur demand for crude. So since Metro Manila in particular is under GCQ, we've seen vehicles piling up again in our major roads. So of course there could be spur in demand for crude. Then for infra and cement, we are negative also for this sector as significant drop in cement demand due to the stalled number of constructions. And for the cement manufacturers, operations have yet to return to optimized levels. And for infra, I'd like to mention Megawide because they're managing the Cebu airport, and with Cebu back or have been demoted to ECQ, there could there operations there could be adversely affected by the downgrade to ECQ. But for some positive points, prices of raw materials and imports have eased because of this lockdown period. No one's consuming anything related to construction or raw materials. No one's purchasing that much. And of course, the resumption of construction activities in areas under GCQ is very positive for the sector. So last sector is gaming. We are also negative for this, as we might see record low casino revenues because of the closure, and with expansion plans put on hold because of this quarantine. Then for the overall for the sector, there could be lower tourist arrivals once we emerge to a new normal, be it local or foreign tourists. So this is very, very bad for casinos. But on a positive note, hotels and reopening of stores could provide some relief in revenues, and possible reopening of casinos by 3Q, because Pagcor is pushing for it, and Pagcor has been consistently um, recording higher revenues for the past few years. So they might have the upper hand for the possible reopening of the casinos. So to sum it up, coronavirus impact could linger on the broader economy, and aftershocks could be felt long after the virus containment. So even if vaccine could be developed by this year or next year, um, people's ways would change on how they do things, how they transact, or their everything that they do could change because of this global pandemic. So same goes for companies. They might be they might innovate ways on how they could operate in the next few years once we emerge to a new normal. Then for economic outlook, of course, it would be dim for second quarter onwards, with a possible recovery by 4Q. As previously mentioned, some sectors could recover as early as second half. However, some might bleed it out for the whole year and could take maybe um, to recover by 2021. Then risk of sentiment might prevail in the short run because, as we can see, cases continue to spike with no end in sight, and containment measures have yet to be fully utilized. But we're seeing some attractive upside for companies that are positioned for a strong rebound post-pandemic. However, we would like to reiterate that there could be a steep drop in second quarter corporate earnings, so it will be bloody for companies. And with that, I'd like you to exercise your risk management. We would like you to instill a defensive strategy in your investing plans. So we updated you with our sector calls, so it could be a great help for you if you were to come up with a plan on which sectors to invest in, which stocks to buy, or which companies to avoid. So I guess that's it for the quick market update. Stay tuned for our next webinars. Thank you.